Hello and welcome to the first lesson of our 2-hour hotel acquisition renovation modeling test. In this lesson, we're going to cover 4 main points. I'm going to start by giving you an overview of this case study and how it's different from the simplified one in the introductory module. Then we'll go into the actual operating and renovation assumptions. We'll look at the market and hotel level assumptions, and then we'll look at the revenue and expense assumptions. Now, we're not going to have enough at this point to actually fill in all the assumptions and numbers around the acquisition, the financing of the property, and the exit, nor will we have enough to actually fill in the property pro forma, but we will build up to that, and we will fill those in over the course of the next few lessons here. As always, you can certainly read through the case study document if you want. It is a few pages long and it sums up the scenario here, some of the numbers that we're going to be using, and the differences between the different scenarios in this case study. So what is this case study? At a basic level, it's really just a more complex version of the 60-minute hotel acquisition and renovation case study in the introductory module that was based on that hotel in the Northern Territory of Australia in the city of Darwin. The pro forma here and the revenue and expense drivers will be very similar to what we had there. Some ideas have also been taken from the 3-hour office development case study as well. For example, we have multiple scenarios here, we have multiple different exit dates, and some of that additional flexibility that we're building in is taken from the office development case study. The main question here, as you can see if you scroll to the bottom, is if we're targeting a 20% IRR in the base case, a 10% IRR in the downside case, and a 30% IRR in the upside case, should we acquire this property for around $228 million US, spend about 20 to 25 million on the renovation, and then sell it after a 3 to 5 year holding period? Another question here is, should we keep operating the hotel independently, or should we have the hotel join a franchise? Now, there are many differences between these two models, but at a basic level, if a hotel operates independently, it's generally going to be cheaper to run. So the management fee will be less. There will not be any type of franchise or brand fee associated with it. Not everything will be different. Some of the operational assumptions will actually be quite similar, but generally speaking, a hotel that is independent will not be spending quite as much on administrative and general expenses, nor will it be spending as much on sales and marketing. Renovations also tend to be a bit cheaper if it's not part of a franchise. On the flip side, though, there are some advantages to the franchise model. So if you join a brand like Hilton or Hyatt or Marriott, for example, usually you can get a higher occupancy rate and a higher average daily rate because you have access to a much wider set of customers. You have access to a built-in customer base that has been developed over many years. And so generally the occupancy rates and the average daily rates are going to be higher with this franchise model. So that's one of the questions that we'll be looking at here. We'll also look at the risk factors and how we might mitigate them in this deal. And then we'll also think about how much debt we can use and what the main constraints on this debt are. What makes this case study more complex than the 60-minute version is, first off, we have multiple market scenarios for the 5-star hotel market in Dubai. And you can see it by looking at the Excel file here. We have a base, downside, and upside case for the market occupancy rate, the market average daily growth rate, and then we assume that our property can capture a certain percentage of this market occupancy rate and also a certain percentage of this average daily rate. We have different assumptions for other revenue growth and also for the expense growth rate. Then we have multiple operational scenarios for the hotel itself. So we don't just have a base, downside, and upside case, but we also have really 6 combinations here because the hotel could be an independent hotel or a franchise hotel, and then it could operate in those 3 market scenarios as well. So we have a total of 6 different scenarios here. We have different potential exit dates, which is something that we skipped over in the simplified case study. We always assumed the hotel was sold at the end of 5 years. And then we're also going to create sensitivities for everything above. In some cases, these will be quite short and fairly compact, like the ones at the top. And in other cases, there will be a bit more to them, and we'll look at a wider range of numbers, such as in the sensitivity tables at the bottom. So that's how this case study is more complex than the 60-minute version. The bottom line is that you need to have an understanding of the basic version of this model in Module 1 before you attempt this case study, because we're not going to go over what a hotel pro forma looks like, or what the revenue and expense drivers are, or what the different line items mean. You have to know some of that going into this. We also recommend taking a look at the setup for multiple scenarios in the 3-hour office development case study based on 100 Bishopsgate as well. If you do that, you'll have a much better idea of how these scenarios differ and how the market changes depending on what you assume and whether the market performs in line with expectations or above or below expectations. So that's it for our overview. Let's now go into part 1 here and talk about the operating and renovation assumptions. And I've been over some of this before. The basic idea is that running a hotel as part of a franchise, such as Hilton, Hyatt, or Marriott, tends to be more expensive, but generally speaking, properties can also get higher occupancy rates and average daily rates. So it's a pretty simple trade-off. Is the added expense actually worth it, or is it not worth it? We're also going to set up some other assumptions for the renovation end date and for some of these scenario cells with drop downs at the top. Now, we can't fill in any of these sensitivity tables here because we need to finish the whole model first, but these are just here at the top for our convenience. It makes it easier to look at the different scenarios and draw some conclusions later on. First off, for the renovation end date, we're going to use the EO month function as always. For the start date, the acquisition date here is December 31st, 2016, so we'll take that. We'll take the number of renovation years, and then we'll multiply by the months in the year. And so we can see that our renovation lasts for 2017 and 2018. And by the way, this is actually what happened in real life with the Jumeirah Beach Hotel. I'm changing the numbers a little bit, and I'm adding a few things and subtracting a few things here and there, but this hotel really did go through a renovation from 2017 into 2018. For the selected market scenario, let's do Alt-DL for data validation. And then for the allowed cells, let's select list. And then for the source, let's go down and take base, downside, and upside from right here. So now we have that. And let's just change this to the base case scenario for now. And then for the selected operating scenario, for this one, we want to select a list as well. And we can select independent and franchise from right there. So we have that. And I'll select independent for now so we have something there. Now, the next part of this is to fill in all these numbers. These all come directly from the case study document. So we're not doing any extra outside research or anything like that. They've all been given to us in that document. To set this up, I'm going to use an index and match function as always, and we'll select our two possibilities here. We'll say 1 for the row number, and then for the match, we will take our operating scenario right here, and then we'll match it to independent and franchise up here at the top. And I'll anchor those cells so that this does not shift around as we copy it down. So let's just do this and copy down all these numbers, all these formulas really. And so we have all this filled out. If we want to check quickly that it works, I can change it to franchise, and you can see that everything now updates as you would expect. With that set up, we're really done with the first part here, the operating and renovation assumptions at the top. Let's now move into part 2 and look at the market and hotel level assumptions. The main thing to keep in mind with these assumptions is that we're assuming that there will be a downturn or recession in the Dubai hotel market for the first 2 years, so roughly 2017 and 2018. If you look at the ADRs, they have been falling over the past year or two. So it usually takes a few years to get out of that. And the difference between the cases is that the recovery after these first 2 years will be faster and more pronounced in the upside case, and it will be slower in the base case, and the slowest and the least amount of recovery in the downside case. Let's go down and take a look at this. Once again, I'm going to use index and match functions to set this all up. So we'll index this area above, then we'll enter a match. We will go up and take our market scenario right here, base, downside, or upside, and then we'll match it to this area on the left. And we will anchor the C part so that does not shift around. And we have that. And then we can copy this across. I'm going to go through and just copy this across for all these just so we have it in place and so I can give some commentary on the differences between these different scenarios once we have this all set up. So we have at the market ADR growth here, and then other revenue growth and expense growth. So we have everything here set up. With the market occupancy rate, you can see what happens. In all of these cases, it falls in the first 2 years, but then after that, it starts recovering. And in the base case, it gets up to almost its old level. It gets up to almost 85% by the end. In the downside case, it doesn't quite get there. It goes up to 83%. And in the upside case, it does even better than its current occupancy rate, and it goes up to 87%. For the average daily growth rate, you can see it's fallen in the past year. And then going forward, it'll fall again in the base and downside cases over the next 2 years. But then after that, it will recover. The difference is that the recovery is a bit sharper and more pronounced in the base case and is not quite as much in the downside case. In the upside case, we have something a little bit different because the recovery starts in year 2 and then it keeps going, and the ADRs grow at a fairly standard rate of around 2 to 3% after that. And then other revenue growth follows this general pattern as well. It's pretty closely linked to the ADR, where we have a bit of a decline in the first 2 years and then recoveries after that. And then in the upside case, how it doesn't change at all in the first year. And then after that, we get a small increase followed by 2% or so increases. With the expense growth rates, this one is a little bit different because expenses are unlikely to fall even if the ADRs fall or the other revenue growth falls. Usually these are going to keep increasing. However, it is true that when the market is doing better, expenses will also tend to rise more quickly. So in the base and downside cases, these simply rise at lower percentages. And then after that, they start rising more quickly and eventually get up to around 2% growth in all these different scenarios. So that's the short explanation for what these scenarios mean and why we set them up like this. With this model, we're also assuming that there's an overall occupancy rate in this Dubai 5-star hotel market and an overall average daily rate across all the hotels. And then our property will perform at some percentage of those rates. So for the market average daily rate, let's take our old number and then multiply by 1 plus the ADR growth rate right here. Copy this across and just ignore this error. These things are annoying me, so I'm just going to ignore all those errors. For the market RevPAR, this is just equal to the average daily rate times the occupancy rate. So we have that. And then for the property occupancy rate, we take our selected market occupancy rate, and then we multiply by the percent of that we're actually capturing. This is named cell prop_occ_PCT for percentage. For the property's average daily rate, we can do something very similar and just take the market average daily rate, and then we can multiply by the percent that we're actually capturing, the 90% in this case. And then for the property's RevPAR, we can take the occupancy rate and multiply by the average daily rate. Copy this across, and then copy all of these across as well. Also going to ignore the error on these others. And so we have that in place. Now, if you think about the numbers here very quickly, you can see that there's a pretty dramatic difference between the historical year and then the first projected year and the second projected year. If we look at the average daily rate here and compare it to the market average daily rate, it's only about 78%. But then as soon as we go into year 2, or really year 1 of the projection period, and then year 2, it goes up to around 90%. So we have a big jump here between the historical year and the first 2 projected years. You could debate that and say that maybe we should wait a little bit, but this is really the whole point of completing a renovation project like this. We should expect to see some type of big jump like that. If you want to see what this looks like in other scenarios, we're in the base case under the independent operating mode right now. Our property average daily rate goes from 350 all the way up to 432 by the end. RevPAR goes from 273 up to 347 or 348 by the end. If we change this, and let's say we select the downside case, Our property's ADR still ends up increasing, goes up to $398 by the end, but it's quite a bit less than before. And our RevPAR also still goes up to around $314 by the end, but it is quite a bit less than it was in the base case. And then finally, if we change it to the upside case, now we have some pretty substantial increases. The ADR goes up to $460 and the RevPAR goes from $273 to $380 by the end. So you can pretty clearly see how these are all different. And if you want to, you could try changing this to franchise as well and see how that's different. Everything here looks pretty positive when we select franchise because RevPAR goes up to more than it did as an independent entity, and so does the ADR. Of course, you don't see the cost or the disadvantage of that because we haven't actually calculated all the expenses yet. For now, I'm going to change both these back to base and independent for the scenarios. That's all we have to do on the market and hotel level assumptions. So let's now go down to step number 3 and look at the revenue and expense assumptions. Now, in some ways, this is actually simpler than what we had in the 60-minute version because we don't have to build in flexible renovation start dates, end dates, renovation years, renovation factors, anything like that. Instead, they just tell us that the renovation is going to take 2 years, 25% of the rooms will be unavailable in year 1, and 50% will be unavailable in year 2. Once we have that set up, we can calculate the days in the year, the available room nights, and the occupied room nights in pretty much the same way that we did before. And I have some notes on a few of these other items here, but we'll also touch on these as we go through this exercise. For the renovation factor, then, I'm going to say 0%, 25%, 50%, and then 0% for each year after that. And then for the renovation costs, I'll say 0 in most of these years. And the only year where we're really going to enter something is fiscal 2017 and also fiscal 2018. So for this one, we'll take our renovation cost per key, we'll multiply by the number of keys or number of rooms, 618, and then we'll divide by the number of renovation years, 2. So we have that, and we can copy that across. For the days and period, we take our starting date, and then we go back 12 months to calculate this. So we'll go back a negative number of months right here. So really just negative 12. And then for each date after that, we can just take the year that we're in and subtract the previous year. For the available room nights, we can take our days in the period and then multiply by the number of keys that we have. And then for the occupied room nights, we need to take our property occupancy rate and then multiply by the available room nights and then multiply by 1 minus the renovation factor up here. Because if 50% of the rooms are unavailable, then our occupied room nights are going to be 50% lower than they would be normally. Copy that across. And then for all these expense assumptions for the food and beverage revenue, the utilities, the insurance, the property taxes, all of these were given to us in the case study document. So if you look at it under part 2 operating assumptions, they give us all these numbers right here, and that is where all these are coming from. Now, they only give us the initial numbers here, so we need to grow these at the appropriate growth rates over time. For the food and beverage revenue per occupied room night, let's take our old number and then let's multiply by 1 plus our revenue growth rate. I'll anchor the 101 part so we can just copy and paste this around. And then for other revenue per occupied room night, we can do the same exact thing, and then we can copy this across. We have that. For the expenses, utilities are based on occupied room nights as you'd expect, because if no one's in the room, you're probably not going to be using much in utilities. Insurance, property taxes, and reserves, on the other hand, are based on available rooms. So these are more in the way of fixed expenses as opposed to variable expenses. For utilities, let's take this and multiply by 1 plus our expense growth rate. And we can do the same thing for everything else. For the FF&E reserves, this one changes based on the scenario that we're in. So we need to go up and link to it right here, the initial FF&E reserves per available room. Once we do that, then we can copy this one down just like we did for everything else. And we can do that. And then for the ground lease, this is something that we did not see before either. We'll take the old number and then multiply by 1 plus our expense growth rate. So we can actually just copy and paste down the same formula here. The reason this exists is because in this case, the hotel does not actually own the land that it's on, so it's leasing the land from Dubai or from the UAE or from whoever is in charge here, and you will often see this type of ground lease line item when you're dealing with hotels. I have a couple of other notes here on the side for other items that you might be curious about. Just like in the Northern Territory, there are no property taxes in Dubai, but there are fairly high taxes percentage-wise when a property is first acquired. So we'll look at that when we get to the acquisition, exit, and financing assumptions. The F&B revenue here at $125 per room night is quite high because this hotel has 21 restaurants. That is far more than a normal property, even most 5-star properties. So we represent the sheer number of restaurants with this figure. We could try to do it differently, and we could try to factor in foot traffic to the restaurants from non-hotel guests, but we think that in this case, the vast majority of the traffic will be coming from the hotel guests, so we factor it in like that. Most of these guests are on vacation. This is clearly more of a vacation hotel than a business hotel, so presumably they're going to be eating and drinking a lot. We don't think $125 per night is that crazy if the average room has, say, 2 to 4 people in it, if you assume that these are mostly couples or families. And then other than that, most of the rest is fairly normal in terms of fixed versus variable expenses. With that done, we're now at the end, so let's do a quick recap and summary. In part 1, we set up the operating and renovation assumptions and saw how we can use data validation to get our scenarios here set up. To calculate the renovation end date, we can use the EO month function, and then we can use index and match to pull in the appropriate assumption for independent versus franchise options here. And franchise gives us probably a greater occupancy rate and ADR, but also is more expensive in terms of renovation and more expensive in terms of ongoing operating expenses. Then we went down and filled in our market data and scenarios and saw how the assumptions here differ in the base, downside, and upside cases. In all of these cases, we assume that we have somewhat of a recession or downturn in the first few years, followed by a recovery after that. We get the sharpest and strongest recovery in the upside case, less so in the base case, and even less so in the downside case. We assume that our property captures a certain percentage of the market occupancy rate and the market average daily rate, and use that to calculate the metrics for our property down to RevPAR. And then we also had assumptions for the other revenue growth and the expense growth rate. Then we looked at the revenue and expense assumptions and had something for our renovation factor and renovation costs. These do not need to vary, so we don't need to have super flexible formulas here. We calculated our available and occupied room nights, our food and beverage revenue, our other revenue, our utilities, insurance, property taxes, and FF&E reserves. Some of these are based on occupied room nights, some are based on available rooms, and it really depends on what the assumption is and whether it's a fixed or variable expense, but most of it here is common sense. And then finally, we had a ground lease here, which is something you haven't seen before, but which is very common for hotels. That's it for this introductory lesson. Coming up next, we will turn our attention to the property pro forma, and you'll see how to move from these assumptions into the pro forma itself. Then we'll get into the acquisition, exit, and financing assumptions after that.